Hello and welcome to Season 2, Episode 5 of the Talking Central Banks podcast with me, Karan Medici. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about the monetary challenges faced by the banqueduliban, or the Central Bank of Lebanon, since the liquidity crisis of 2019. That was a result of the catastrophic sovereign default that crippled the Lebanese economy. Since that event, Lebanon has been facing a multitude of crises, for lack of a better word. Post 2019, currency devaluation was over 99%, and the GDP fell by almost 70% to just over $33 billion by 2020. In combination with the COVID-19 related economic degeneration and complications, Lebanon faced significant capital outflows resulting in a forex crisis and hyperinflation, which was recorded at over 250% in mid-23. Inflation, as a matter of fact, is still recorded in double digits as on 26. The Israel-Hezbollah war, on the other hand, has had further negative implications on the economy, with the central bank failing to cover all bases despite firing all cylinders. Talking about this is Nicholaas Schoenmaker, who was described by the Financial Review Australia as the Fundie who once vacationed in a failed state. Nick was a portfolio manager with Drummond Capital and senior cross-asset investment specialist with Aberdeen Standard Investments. He is currently a partner with Portfolio Constructions Forum in Sydney. Welcome to the show, Nick.
Oh, Karen, it's a pleasure to be here, and thank you for having me on. I've been following your channel and your many fantastic segments for quite some time, so it's an honour to be here today.
Thank you, Nick. My absolute pleasure. So, Nick, historically, Lebanon has been known as a Switzerland of the East for its banking secrecy and stability.
Yeah.
Now it is famous for crisis. Could you please share the entire transition as you observed and experiences during your travels there and while you were on the ground?
Yeah, I can. And look, just first, I need to say what I talk about today are my own experiences, my views, and not those of the Portfolio Construction Forum or their affiliates. Now, with that said, look, I've been travelling, Karen, through the Middle East, the Levant, the Gulf for about 20 years. When I went to Lebanon in 2023, it was indeed my fourth time being there. And one of the things that really fascinated me about going to Lebanon was there's a remarkable resilience and passion of the people there. And as you described, it used to be the Switzerland or the Paris of the Middle East. And it's gone through a 15-year civil war. And one of the things we should note about that is that even through the civil war of horrendous bloodshed and sectarian conflict for 15 years, there was no sovereign default, but there was after the period that you mentioned. There has been the Arab Spring, the crisis with Syrian refugees coming in, the energy price spikes and all the things related to COVID, the war in Russia and Ukraine. We had the port blast. We had a lack of a president for many, 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 many years. And ultimately, it resulted in a total collapse of the banking system. And before that, as you rightly said, Kran, there was a sovereign debt default. So I think the way to think about Lebanon, it could be described as a banking collapse, but in reality, I think it's a broader collapse of a financial model, a fiscal model, and fiscal dominance is something we're seeing throughout the West now, causing complications for currencies, central banks, setting interest rate policy, but a creditability model as well. And for decades, Lebanon was the banker of the Middle East, a little bit like, as we were speaking about offline, as Dubai has been more recently. We had a fixed exchange rate of $1 to 1,500 lira, very high deposit inflows. And if you go back to the time in the 5 or so years, 10 years following the financial crisis or the GFC, you had virtually zero policy rate settings through the West. and the banking system in Lebanon was attracting these highly attractive low teen yields for foreign depositors into US dollar bank accounts. There was a banking system that was deeply intertwined with the sovereign, and we'll talk a lot about that through our conversation today, and essentially a central bank that effectively became the state's balance sheet manager. When we had the start of the collapse in 2019 is a good proof point to mention, which you did, inflows started to stop. There was previously the attractiveness of Lebanon because of banking secrecy. When there was questions about the way that the relationships between the sovereign, the central bank, and the commercial banks, how that was intertwined, there was ultimately a shortage of US dollars. And we can go all the way back through time and look at things in the Asian currency crisis where we had similar dynamics. But what makes Lebanon uniquely instructive today is that it kind of shows us what happens when fiscal mismanagement becomes structural. Central bank independence becomes blurred, and this is not to the levels that pale into insignificance that we may be seeing in the US. We've had calls of that around the European Central Bank over the last couple of weeks. This is a real lack of faith in institutions and essentially a collapsed government. Deposits being depositor trust being totally broken, and then the geopolitical cost of repair. So it's not just a crisis story, it's a case study in capacity, monetary credibility, and really the limits of financial engineering through the BDL, through the banks, and through the sovereign. So when I went there, which was last time when, as you mentioned, the Financial Review wrote the article of a Fundie travelling to a failed state, and really part of what I wanted to see was what is life like in a country where the banks are quite literally closed. The banks are boarded up. The central bank is boarded up. These institutions had effectively closed. The public banks were closed. When I went there, I took hard cash with me of US dollars on me with the anticipation that no electronic form of money would work. And one of the things that has complicated Lebanon versus so many other countries, and we could look at Sri Lanka, who got an IMF bailout through similar problems, the sectarian structure of the political system in Lebanon has just complicated everything because of the post-Civil War TIFE agreement was called, where policy was shared through the members of the various, essentially, warlords of every denomination in Lebanon. So there's often policies made based on sectoral preference and not the end community in mind. We had the twin deficits, massive current account deficit, massive fiscal deficit, and when we had conflict in the Middle East, Syrian refugees, some of the tourism and the diaspora of Lebanon, which really was the most of their GDP, slow down. So you had these confluence of events with a lack of tourism, with an economy that doesn't really do a lot. There's potential for agriculture. There was a fantastic banking system that used to attract foreign capital. When questions arose around the credibility of that, money fled, currency fell. When I was there in March 2023, $1 was 150,000 Lebanese lira. Hyperinflation, no state services, and essentially an economy where people were quite literally walking around with bags of money, which were not worth a lot. So there was just a real confluence of things that became a total disaster for the country, Karan. So I'll leave it there to set the scene, and then we can go a bit deeper if that works.
Very interesting, Nick. By the way, I view Lebanon as a case study in the breakdown of the monetary side of the economy. So on the ground, Nick, what did the collapse of the Lebanese banking system and currency actually look like in daily life and business activity? Since you mentioned that people were actually walking around with money bags.
quite
What were
yeah.
the key tipping points as well as policy choices
Yeah.
versus political constraints, Nick?
Sorry, what was the last part of the question? Sorry, Crane.
So what were the tipping points, Nick, as well
Yeah,
as policy choices versus political
yeah,
constraints?
yeah. So the tipping points, if we go back, was the default on the euro bonds, the port blast exacerbating a fragile economy, the lack of a president for many years, the loss of the state to, and I make no political reference one way or another, but essentially
Right.
to Hezbollah. Um, the fact that the Gulf countries, and this is very topical with what's just fed up with Iran, the Gulf, and Israel and the US, but the Gulf countries historically being very big investors into Lebanon and pulling away as Iranian proxy influence through Hezbollah got stronger. Uh, Lack of tourism, refugees, everything coming together to create a total economic collapse and humanitarian collapse. But to answer your question of like observations of what did this actually look like, 8 total ATM limits. The banks closed and boarded up. There were cases in the months before I was there and when I was there where members of the community would have, for example, someone's mother might be dying of cancer and someone would go into a local bank when they were open a couple of months before I was there with Molotov cocktails and machine guns trying to not rob the banks but get some of their deposits. The whole concept of fresh dollars versus lollars was a big thing there. Informal foreign exchange markets, businesses pricing US dollars, but people paying staff in Lebanese pounds. And one thing I'll never forget is driving around and seeing past bus stops in the 20s, the 30s, the 40s of military personnel. And the gentleman that I was driving around with at the time, I was saying, what are the military doing there? And he said they're hitchhiking because they don't have a dollar to catch the local bus. So you had
Okay.
people that worked for the state in a terrible condition. So people would quite literally walk around with bags of cash. The political area in the downtown area, which is this really salubrious place, was a ghost town, all but a ghost town. State services have always been temperamental and fragile in Lebanon, and electricity is the most notable example, but that was exacerbated more. One thing I will say is there was a total wiping out of the middle class. Everyone was essentially in poverty other than the elites, which are families of the politicians, some of which had transferred, I think there was a total of $13 billion or thereabouts of politically aligned money leaving the country before the collapse. There was also the very few that got paid in US dollars, and then they were the new elites as well. But everyone else, including the previously relatively quite wealthy people, had all their money stuck in the banks. And at the time, the IMF bailout wasn't able to be implemented or agreed upon, like what we've seen in other countries with similar dollar funding issues like Sri Lanka, because there was no banking reforms that were needed. There was no functioning government, and a whole confluence of things around that. So there was really a total inability to maintain the peg that was reliant on dollar flows into the country. The tipping points, as you say, were the imposition of de facto capital controls, really without legal clarity, and the loss of convertibility of deposits. And once that kind of convertibility is broken, the deposits cease to function as money. It becomes essentially worthless, as does a peg. It's really a promise in many cases if the reserves aren't there. So politically, there were constraints. The losses were enormous and have been enormous. And allocating them requires deciding who bears the losses, the equity holders, the banks, the central banks, the depositors, the sovereigns, and how that all works out in some sort of coordinated matter, which is being hotly debated in the parliament in Lebanon right now.
Right. What lessons does Lebanon offer, Nick, about the link between fiscal mismanagement, banking systems, and central bank independence? You can perhaps talk about the spillovers, Nick,
Yeah.
namely geopolitics, sanctions, and economic statecraft in your assessment.
Yeah, so I guess look, the core lessons of the questions you've asked there, and they're fantastic, thank you, is when a sovereign and the banking system are deeply intertwined, sovereign stress becomes banking stress. And you correctly pointed
Right.
out the Eurobond default. Lebanon's banks were very large holders of the sovereign debt. The central bank intermediated heavily between the two, and this is where sometimes people have referred to it as a Ponzi scheme. And when a lot of the money left the country, which was worse, I think, than what sanctions were, because it exacerbated dollar funding to a critical extent. At the same time, fiscal deficits were persistent and current account debt levels were way too high. But when those inflows continued prior to the collapse or the crisis in 2019, it kind of all worked. So the central bank independence was really blurred when the monetary authority effectively financed the state. Um,
Right.
and the geopolitics, as you said, compounded this. There were sanctions. There are the fact that there's regional instability, which may be exacerbated now. There's the Hezbollah dynamics. These factors do raise risk premia and reduce inflows, particularly from the Gulf countries. And we can talk about what's happening now, if you like, and how that may influence. But it really shows that monetary credibility cannot substitute for fiscal credibility indefinitely. And then when you overlay that with a country in the middle of Saudi, Iran, France, the US, and a whole interplay of regional actors, it becomes a very, very difficult playing field. So some of the things they're looking at now, which we'll talk about a bit later, is around how some of the longer term deposits for the high balance people can be backed by the BDL or the central bank. But then how does that work when gold is some of the central bank assets trying to back those deposits? There's other stipulations in the constitution that don't allow that. So it's all still a little bit convoluted as to how it works out. But sanctions have been difficult. The withdrawal of the Gulf, when the new president, that has only happened over the last 12 months or so, is more US aligned. That was looking positive, but now where we've had a ceasefire with Israel and Lebanon, but there have been still parts of Lebanon occupied, if that's the right word, by Israel, and almost every few days a targeted attack in Lebanon. With what's happening with Iran now, I mean, who knows how this could or could not escalate. The Prime Minister, Salam of Lebanon, has come out and criticised Iran for the attacks in the Gulf. But who knows how all that plays out? But that's definitely the war premiere risk is a real problematic potential for the recovery that is needed in Lebanon.
Right. Lebanon, Nick, does not seem to have a functional guarantee system that protects small depositors in case a bank fails. And you did give some very interesting examples of that happening on the ground.
Yeah,
There are also restrictions in withdrawing USD deposits made before 2019,
yeah,
with such withdrawals attracting severe haircuts, as per news
yeah,
reports.
yeah,
This was perhaps done to as a restriction to capital control and capital flight, I mean, and
yeah.
destroyed depositor confidence in the system.
Yes,
People consequently hesitate to keep their USD deposits in commercial banks as they have lost trust on central banks now, apparently.
yeah.
How do you see the central bank restoring confidence among citizens, Nick?
Well, look, there's a very long way to go, and I think the credibility of the entire institutional framework in Lebanon has lost all faith with the country. So there's a long way to
Right.
restore that. But I think specifically to the central bank, confidence is going to come through clarity, enforceability. There's a number of pillars that I think are required to kind of get there. Legal capital controls, not informal restrictions. We talked about multiple currencies and a black market in the exchange rate. Transparent loss allocation is needed. We still need banking reform. We still need the IMF bailout. We really need to know the hierarchy of claims and how that's clearly defined. As you correctly mentioned, when I was there, the ability to withdraw money in US dollar accounts was purely through lira and at a different rate to the day-to-day black market rate. So regular people taking an even bigger haircut. So the draft restructuring framework has attempted to prioritise smaller depositors, so less than 100,000 US dollars, which is 85% of deposits. That's socially stabilising to some extent. But there's this kind of asset backing ambiguity over the longer term and high balance deposits, which I alluded to before, which could become unfunded liabilities of the central bank and then the sovereign. So that could just be shifted forward without confidence. So that's going to be problematic for people that have more political influence in the country, I would say. So it's not that the confidence is restored by decree. It's going to be restored by predictable rules. And we need a really cohesive functioning government and a less historically sectarian one, I think, to get to that point. So there's some tentative signs of positive action, but I think we've got quite a ways to go.
Nevertheless, at this time, Nick, most of the transactions are USD denominated in Lebanon. Can you explain how this arrangement functions? I think when it comes to a dollarized economy, Lebanon is probably one of few countries across the world where most transactions are exclusively happening in the USD and not in the domestic currency.
Yeah, and so it became as I said, when I was there in March 2023, it was $1 to 150,000 lira, and the peg before that was $1 to 1,500. So Lebanon really has dollarized informally. Prices for most goods, as you mentioned, are in US dollars. Transactions are settled in US dollar physical cash, so that makes it a very valuable commodity. The Lebanese pound does still exist, particularly for wages, and I mentioned people working for the state, the military, the teachers were terribly well off. Sorry, not well off, struggling because being paid in lira, but transactions in dollars. So the country, I think, the way to kind of think about it is that it's operating with a domestic currency for accounting purposes and some wages, the lira, but a foreign currency, which is the dollar, for real value, storage, and trade. So the arrangement functions to some extent, but it totally fragments society even more than it is fragmented. The very few that do have access to dollars are in a different economic tier than those without it. So it's a economy that is using dollars as not because of a preference for them, but as a necessity with the volatility and hyperinflation and dollar funding issues that has created that backdrop, I'm afraid.
Right. Can you talk about the fundamental shift of the economy, Nick, from a banking heavy model to a highly dollarized cash-based economy, as you just mentioned?
Yeah. Well, it was, as you say, it was a banking heavy economy, and it was the Banker of the Middle East before Dubai.
Right.
And you correctly point that out. Other than the tourism and diaspora, it was banking and a little bit of agricultural work. So it was huge. So Lebanon did move from a bank intermediation model to cash circulation model, I guess is the way to say it. And when, as we talked about, deposits lose credibility, people exit the banking system, banks are closed, I guess in a technical term, cash velocity increases, shadow finance is a way to think about it, expands, intermediation starts to shrink. So it's a very unique thing to see coming from a Western country like Australia. But the economy becomes less efficient, less taxable than it already was, and less transparent. And it really feels, and again, this is really one of the resilience of Lebanese people. They're always survival based, but you create a country that really is survival orientated rather than investment orientated. And this is one of the problems with everything that happened in the interrelation between the banks, where politicians were big equity holders, the state, and the central bank. It's very difficult to attract foreign investors at any yield now. And I think the exit yield on the local currency bonds or the sovereign debt at Lebanon at the moment is about 14% exit yield. So it is a very unique system, to put it modestly.
Another interesting development, Nick, I see is Al Qardal Hassan operating as a parallel banking system,
Yeah,
providing microloans and gold-backed loans entirely outside the central bank's regulatory
yeah,
framework. How do these multiple systems operate simultaneously in the macroeconomy, Nick? It will be
yeah,
interesting to know how the central bank is able to control the monetary system given this very interesting background we have here.
yeah. It's an interesting one, and that kind of transpired after my time there. But it's as you kind of say, and what the conversation would allude to, when formal institutions lose trust, parallel systems emerge. So what you've explained, and my understanding of it, is that it's the operations outside of the traditional regulatory framework, providing micro loans. They are gold-backed lending in many cases. And in macro terms, I guess, to describe that in usable language would be fragmented monetary channels, reduced central bank transmission power. There would be, safe to say, multiple liquidity circuits operating simultaneously in that environment. And then clearly, as a result of those things, you would have a central bank's ability to control the money supply materially weakened from that, I'd say dramatically in such an environment. When I was there, the central banker, I think, had arrest warrants out for him in France and other countries. But it's a highly unorthodox system that probably, Karan, something you're a little bit more familiar with in your work through frontier markets than I was before going there.
Yeah, yeah. Seems very similar to what was happening in Afghanistan or even
Mm,
Syria, for that matter, I think.
yeah, yeah, yeah,
The central bank has tried to peg the exchange rate, but the market is not ready to accept it due to mismatches in demand and supply, Nick. This
yeah,
basically means that the public has no trust in the peg set by the central bank
yep,
or the central bank's ability to shore up the currency's value. How
yes.
can the central bank fix the exchange rate crisis, in your opinion?
Yeah, it's a good question. I think everything you say there has got a lot of validity. So I think, a peg can't survive, first of all, without reserves and without credibility of institutions.
Right.
To get anywhere near fixing the exchange rate crisis, you'd have to, first of all, unify exchange rates, establish, and I alluded to this before, legal capital controls, conduct, I think, a huge asset quality review of the banks, and that's been outstanding for 5 years or more now, and really anchor fiscal policy credibility. There'd need to be securing, finally, of external support from the IMF, which has been ongoing for 5 years. And now, as I said, with the Gulf countries, it was looking like the Gulf would be playing a bigger role with coming back into investing in Lebanon as Hezbollah was disarming. There was a more pro-US and West president put in place, but with what's happening now, again, this is another real risk for everything happening there. But without those steps, I mean, interest rates alone can't defend a currency peg, and markets will price sustainability, I think, not any announcements or headline announcements or potentially political posturing around it.
Looking at the central bank's monetary challenges, Nick, the interest rate was raised from 10% in mid of 23,
Mm,
20% currently.
yeah,
And exchange rate is roughly 89,600 per USD based on the recent monetary policy report.
yeah.
Do you expect any changes in the policy rate, Nick, or it being effective in any way to restore market confidence? There seems to be very little macro
Yeah,
data available from the central bank to decipher anything meaningful at this time.
yeah. It's
Yeah,
hard to understand where the policy will go. It feels a little bit like the way that
right.
Turkey's moved in many ways over the years, which seems
Yeah,
so counterintuitive. But I
right.
think in a highly dollarized economy with broken transmission, policy rates lose the potency. Um, in most transactions in the economy, they're US dollars in cash, right? So the domestic rate really has little transmission mechanism or little influence. Raising rates to some extent signals intent from an FX point of view, but without banking normalization, it certainly can't restore trust alone. And we talked before about the reliance of dollar funding from foreigners to maintain that peg for many years. The data scarcity, and you referred to that, further complicates policy calibration. You don't know what the central bank's doing, and that's a really good point you raise. And so in fragile states, monetary policy becomes perhaps, I referenced Turkey, but others that you're, again, uniquely aware of, becomes more perhaps symbolic than operationally effective in nature unless real structural repair occurs. And that's something we haven't seen. We've had some improvements, but we're still quite a way off. And now we've got this regional flare up to take into account.
Right. Another interesting observation, Nick, is that the M1 money supply is Lebanese pound 102 trillion, whereas the M3 is roughly 6,034 trillion,
Yeah,
which is significant in my opinion.
yeah,
And this suggests that the money multiplier is perhaps on an overdrive.
yeah,
I think the difference is because of the frozen deposits, that
yeah,
is, deposits held in foreign currency, and the
yeah,
halting of money printing to contain the hyperinflation experienced by the economy.
yeah,
Keen to know your thoughts on this, Nick.
yeah. I think you've spot on there. So the disparity certainly feels like that would reflect the frozen deposits. So spot on. M3 would include a large foreign currency deposit that are nowhere near fully liquid or partially liquid. So,
Right.
in economic terms, I guess you'd say that M3 is not usable money. It's accounting money, really. It's not transactional money, as we've spoken
Right.
about. So that distortion certainly makes the traditional money multiplier interpretations, I'd say, misleading. Um, and it does highlight again the gap between balance sheet entries and economic reality on the ground is really, really different things in this kind of environment.
In the context of Lebanon, Nick, can you talk about the central bank credibility crisis and how to fix it in a small and often mismanaged economy in the context of
Mm,
the money multiplier going haywire,
yeah,
as we
yeah.
discussed in the previous question?
Yeah, I mean, we could go back and talk about all the political things, but to be more specific in terms of a monetary framework and deliberate for this podcast, I think we'd say the credibility is going to require, transparency, which we've spoken about,
Right,
clear legal mandates on multiple fronts, accountability mechanisms, and separation from fiscal dominance and what's happening with the state to some degree. you'd be aware of this, but I think it'd be safe to say that small states often struggle because of political pressure being rather intense, and it can be slow to rebuild credibility. And that credibility is going to have to be consistently rebuilt over time. I don't think there is any shortcut for that happening. And I go back to talk about the sectarian nature of the political system, the Taif agreement after the Civil War, and just how that has played its part in the state of affairs in Lebanon. So there's I think a slow, steady process of consistent positive action to get to any to get there, really.
Coming back to more central banking stuff exclusively, Nick. On the topic of central bank desynchronization, why does it
Yeah,
matter now, in your opinion, given the geopolitics and rising protectionism? Since
yeah,
we've moved from a synchronized policy to a clear divergence across the Fed, the ECB, as
yeah,
well as the Bank of Japan, what are the
yeah,
most important second order effects of that divergence in terms of FX,
yeah.
capital flows, and long end yields, in your opinion?
Yeah, that's a really good observation. It's very topical because we certainly have moved from synchronised easing to divergence at the moment. We've had the Reserve Bank of Australia
Right.
on a more hawkish path. We've had the Fed on a relatively dovish path. It's a bit more stable now. The ECB being constrained by growth. Bank of Japan, hugely topical, and I'll dive into that in as part of this response. Exiting ultra loose not too long ago, negative interest rate policy. But
Right.
to answer your question, those desynchronization effects, FX volatility, and a lot of what we're seeing now, if we look at yield curves through the developed world, the move index or the volatility in rates markets has been really well behaved, particularly in the US. There's been more long end weakness in Japan, France, the UK than the US, despite fiscal dominance in the US and concerns around central
Right.
bank independence. But capital flows, long end bond yields are affected by what we're talking about. And most relevant to our discussion today, emerging market funding costs. So Japan really is especially important now, not just because they hold a very large share of US sovereign debt. We saw a really big bear steepening or sell off in the long end, 30-year, about 30 basis points in a matter of days a few weeks ago. If those JGB yields rise significantly, global capital allocations can shift from everything from high carry emerging market local currency, structured credit, US treasuries. It can be a very big global thematic. So fragile sovereigns, bringing it back to Lebanon, would feel that squeeze or that impulse really quickly.
Finally, Nick, do you think markets are still anchored to an outdated one global cycle mindset that you often talk about?
Yeah,
You can maybe connect this to the Lebanese case study.
look, it's a good question, and I'd say increasingly no. Geopolitics is really fragmenting cycles now. If we think about oil shock potential, we've seen energy prices above 70 recently, regional wars, sanctions you brought up before, supply chains reordering. These do produce local shocks that don't necessarily synchronize globally. Lebanon is just one really extreme case of that. That does show how a localized institutional fragility can override global liquidity cycles or be totally detached from them, I'd say. And in a world where it still feels like we have abundant liquidity, if trust collapses domestically,
Right.
capital will not stay. So um, for Lebanon now, obviously, with what we've just seen over the last couple of days, any sustained regional conflict increases reform difficulty. And security and economic credibility in this region are certainly linked. So I'd say to kind of wrap that up, it's Lebanon's not simply a failed peg story. I think it's a warning about a number of things that we can think about through the West through emerging markets and everywhere, that fiscal dominance, blurred central bank independence, deferred loss recognition, and the fragility of trust, which is multidimensional around the world at the moment. Once trust breaks, rebuilding that is a very slow and, I'd say, politically painful process. So I think the lesson for policymakers is pretty simple globally, if we think about it, is that, you know, credibility is really cheaper to maintain than to try and rebuild once it's been broken.
Very interesting, Nick. Well, that's all I have for today. An enlightening discussion indeed. It's always a pleasure speaking with you, Nick. Thank you once again for the time.
Thank you. It was great to chat to you.
Thank you very much.